Hi, this is Ishfaq Khan, and in this session, I'm going to tell you how an accounting transaction flows from at the beginning once a monetary event occurs till it reaches the end destination of the financial statements. So, what are the steps involved within that journey? So this is a very basic level of accounting, and definitely it will strengthen your basic concepts of the accounting. So let's start. All right, now let's start with the first process or first step in an accounting transaction. This is the identification of accounting transaction. First, you have to identify an accounting transaction from an event. So the first thing is it needs to be a monetary event. What is a monetary event? It needs to involve the money regarding the business. So let's see with the help of an example. Suppose you are sitting in your office and your boss came in and he had handed over to you two documents. One is wedding invitation card and there is invoices for the business expenses that he has incurred. So in this case, invoices for the business expenses is your monetary event and wedding card is not your monetary event. So you will try to find out the accounting transaction within these business expenses. Okay, the first step is to identify the accounting transaction from a monetary event. Okay, all right, how you will identify and what are the source documents involved? It may be your bills, invoices, voucher, and all these are your source documents once it has transaction has been initiated. Okay, in your case, suppose your boss has incurred expenses of or any other person has incurred expenses of 500 on food expenses for business. So there might be some business meeting, so 500. So this 500, how you will deal with this 500 in your accounting, this is your monetary or accounting transaction. Okay, how this 500 will move on and on and on till it reach the financial statement. This is what we are going to discuss and we are discussing. Okay, this is the first step. The first step is identification of accounting transaction from a monetary events that belongs to your business. All right, so once the first step is completed, then you move on for the next step. Okay, the next step involves in the flow of an accounting transaction is entering that accounting transaction into your journals. Okay, what is a journal? Actually, in your business you keep different books. Okay, one you record one specific book, all the cash transactions, that is called cash book. Credit sales, credit purchases, sales return, purchase return, and journal. Okay, now let me explain it to you a little bit further. I'm just going to give you a brief concept. All the cash transaction you are recording in your cash book. Okay, is cash, you have cash, paid cash, or you have received cash. Okay, and then all the credit sales are you are recording in a separate book that is called sales day book. And then all the credit purchases you are recording in a separate book that is called purchase day book. All the sales return you are recording in a separate book that is called sales return book and purchase return book. And the other which you are not recording in anywhere here, you are recording in journal. This was a brief description how you record. If you are wondering where I will record cash sales, you will record cash sales in your cash day book, because all the cash inflow and outflow you are recording in your cash book. You have different column for bank as well, so cash and bank both included in this book. All right, now these were the books that we used to use in the past. Nowadays we are not using these books. Nowadays we are recording either in Excel or we are recording in some accounting software. So how do these journal look like in nowadays? These looks like this. For bank you have this is a bank and you have debits and credit. Don't bother about what is debit credit, but all the incoming you record here, all the outcoming it is recorded here, then you have a balance. This is how a modern day journal ledger looks like. Okay, so nowadays we are not keeping the record for every day book and then we are transferring it to T account, and then so it is automatically at the first place when you are recording the transaction, it is automatically being recorded in separate ledger for each, like account receivable and undeposited fund and all this. So I just wanted to show you it might be different for a different accounting software a little bit. Their format might be different, their looks might be different, but the basic concept behind that will be the same. Okay, either you are using Tally, QuickBook, Oracle, SAP, or whatever the accounting software it is being used by you. So this is what is the next step is journal, because in this step every transaction is recorded and to specific place where it belongs to. All right, now as I told you, the next step is the ledger account. Ledger is specifically for one specific account. As far as these journal was concerned, as I told you, suppose in case of your cash book, in the cash book you were recording your cash as well, cashes as well, cash expenses as well. So all the cash involvement was being recorded in one book. But as far as these T accounts are concerned, this is like this. This is what we call T account. As far as T account is concerned, it is separate for each account. Suppose cash will be a different account, and if you have cash sale will be a different account. Okay, so all the cash record you can get from there and all the sales record you can get from here. So it is a one step forward recording of accounting transaction. In the modern day, again, this is also your T account. If you see over here, this is your T account. This is your T account. This side is called debit and that side is called credit. This you can say that this is your modern day T account. Okay, if you see like this is your modern day T account. Okay, so the next step is one step further for the classification, because with each transaction, with each step, the accounting information is being classified in more detail. So in the next step it is being classified more. Now from the T account it will move forward towards the trial balance. So T account was a separate for each. For in our case, suppose cash was being separately handled, expense was being separately handled, and then the balance of this cash and balance of this expenses are being recorded in to check the arithmetical accuracy. All these accounts are being written at one place and we are checking their arithmetical accuracy. All their debits and credits are equal or not in one step, that is called trial balance. So how a trial balance would look like, it would be, if you can see over here, you have debit balances and you have credit balances. These are your debit balances, these are your credit balances. So these individual balances are being extracted from each T account. So okay, so then it is brought over here in the trial balance, and at the end all the debits and the credits are equal. So the last step would be the transaction reach the financial statements, profit and loss account, balance sheet, statement of cash flow statement, statement of changes in equity, and the notes to the accounts. So suppose you have incurred some expenses. So expenses would be revenue and expenses are recorded in profit and loss account, and balance sheet is in the balance sheet you record assets, liability, and equity, statement of the cash flow statement, and you have notes to the account. So this is the financial statements. So suppose in our case you have incurred the expenses of 500, so 500 expenses will be recorded here in the profit and loss account. Let me show you a profit and loss account. You should have just a rough idea. So this is a profit and loss account. This is how a profit and loss account looks like. will be different from entity to entity, from company to company. Suppose, cut the story short, in a profit and loss account, at the top you have income, whatever you have earned, and then you have all the expenses, and income minus expenses, you have your profit. So this is a profit and loss account in a very simple layman term. Okay. And similarly, you have balance sheet. In the balance sheet, you have your assets, and then you have your liabilities and equity. Assets are the resources of the business, and liabilities are the responsibility of the business, and equity belongs to the owner of the business. So then it has been further classified to the financial statement. So this was the last step. So in this session, I have just roughly given you an idea that how an accounting transaction flows from very beginning till it ends. So when we are learning the accounting, I will be releasing more videos on basic accounting topics till you master the accounting. So till that time, I'm gonna do that. But why I have put this session as a first session, because this session provides you a rough idea how an accounting transaction flows from very basic till to the financial statement. So I haven't given you any specific numbers, debits and credits, rules and everything. I haven't given to you. I have just given to you a rough idea, the journey of accounting transaction to the financial statement. So once you have a rough idea in your mind, then we will keep on moving on this path till you master the accounting. I hope you like this video. Please click the subscribe button for me, share it with your friends who wants to learn the accounting, and do leave me a good comment in the comment section. Thank you. Take care. Stay blessed.